Hey there, fellow investors. Welcome back to our channel, where we dive deep into the exciting world of stock market investing. Today, we're going to tackle a crucial topic that can make or break your journey as a beginner investor. We're going to shed light on the biggest mistake that many newcomers make when venturing into the world of stocks. By the end of this video, you'll not only be aware of this common pitfall but also equipped with the knowledge to avoid it and set yourself up for success. So, let's jump right in. Investing in the stock market can be an exciting endeavor, offering opportunities for wealth accumulation and financial security. However, for beginners, the complexities and uncertainties of the market can lead to costly mistakes. In this video, we will delve into the biggest mistakes that novice investors often make when venturing into stock investing. By understanding these pitfalls, beginners can develop a solid foundation and increase their chances of long-term success. 1. Lack of education and research. One of the most common mistakes made by beginners is jumping into investing without acquiring sufficient knowledge. Investing requires understanding fundamental concepts, such as financial statements, valuation methods, and market dynamics. Failing to educate oneself and conduct thorough research on individual stocks or investment strategies can lead to uninformed decision-making and potential losses. 2. Over-reliance on tips and hot trends. Beginners often fall into the trap of seeking quick profits by chasing hot stock tips or following the crowd. Relying solely on tips from friends, social media influencers, or news headlines without conducting independent analysis can be detrimental. Such trends can be short-lived, and basing investment decisions on fleeting information often leads to poor outcomes. It is crucial to develop a disciplined approach and rely on solid research rather than fleeting trends. 3. Lack of diversification. Failing to diversify investments is a significant mistake made by novice investors. Placing all funds into a single stock or a few stocks within the same industry exposes the portfolio to unnecessary risk. If the chosen stocks perform poorly, the entire investment can suffer. Diversification across different sectors, asset classes, and geographical regions can help mitigate risk and potentially enhance returns over the long term. 4. Emotional decision-making. Emotions, such as fear and greed, can cloud judgment and lead to poor investment decisions. Beginners often fall prey to these emotions, buying when prices are high due to fear of missing out and selling when prices plummet out of panic. Successful investing requires discipline, rationality, and a long-term perspective. It is important to stick to a well-thought-out investment plan and avoid making impulsive decisions based on short-term market fluctuations. 5. Failure to set realistic expectations. Novice investors may have unrealistic expectations of making quick profits in the stock market. It is essential to recognize that investing is a long-term endeavor, and substantial gains often require patience and perseverance. Being aware of the potential risks, volatility, and fluctuations inherent in the market helps set realistic expectations and prevents disappointment or hasty decisions during temporary downturns. 6. Neglecting risk management. Effective risk management is crucial for any investor, but beginners often overlook this aspect. Failing to set stop-loss orders, not monitoring the portfolio regularly, or investing more than one can afford to lose are common errors. Understanding risk tolerance, setting appropriate asset allocation, and periodically reviewing and rebalancing the portfolio are vital to managing risk effectively. 7. Lack of patience and discipline. Investing in the stock market requires patience and discipline. Beginners often expect quick returns and may panic during market downturns, leading to impulsive buying or selling. Successful investors understand that market fluctuations are a natural part of the investment journey and remain focused on long-term goals. Patience and discipline allow for better decision-making and reduce the risk of knee-jerk reactions. 8. Market timing. Attempting to time the market is a common mistake made by beginner investors. Market timing refers to trying to buy stocks at the lowest price and sell at the highest point. However, accurately predicting short-term market movements consistently is extremely challenging, even for seasoned professionals. Beginner investors may end up missing out on potential gains by waiting for the perfect entry point or selling too soon out of fear. Instead of timing the market, focusing on long-term investment strategies based on fundamentals and market analysis is a more prudent approach. 9. Neglecting the power of compounding. Compounding is a key principle of investing that allows wealth to grow exponentially over time. Beginner investors often underestimate the power of compounding and may delay starting their investment journey. The earlier one starts investing, the longer their investments have to grow. By neglecting to invest early and regularly, beginners miss out on the opportunity to benefit from compounding returns and potentially accumulate substantial wealth over the long term. 10. Failing to have an exit strategy. While it's important to have a clear investment strategy, it's equally crucial to have an exit strategy. Beginner investors often overlook this aspect and don't have a plan for when to sell their investments. Without an exit strategy, they may hold on to losing stocks for too long, hoping for a rebound, or sell profitable stocks prematurely, missing out on further gains. Having predetermined criteria for when to sell, such as reaching a specific profit target or when a stock no longer aligns with the investment thesis, helps maintain discipline and protects against potential losses. 11. Chasing high-yield investments. Beginner investors are often attracted to high-yield investments, such as penny stocks or speculative assets, with the hope of quick and substantial returns. However, these investments typically carry higher risks. Relying solely on high-yield investments without considering their underlying fundamentals and risk factors can result in significant losses. It is important to maintain a balanced portfolio and prioritize investments with solid growth potential and a reasonable level of risk. 12. Overtrading. Overtrading refers to excessive buying and selling of stocks, driven by the desire to take advantage of every market fluctuation. This mistake can lead to increased transaction costs and taxes, as well as diluted returns. It is important to remember that trading fees and taxes can eat into profits, so frequent trading should be avoided unless supported by a well-defined strategy. 13. Ignoring long-term trends. Beginners often focus too much on short-term market fluctuations and fail to recognize long-term trends. Successful investing involves identifying and capitalizing on long-term growth opportunities. Ignoring the broader economic, technological, and demographic trends can result in missed investment prospects. Conducting thorough research and considering long-term market outlooks can help guide investment decisions and identify potential winners. 14. Falling for confirmation bias. Confirmation bias is the tendency to seek out information that confirms one's existing beliefs and ignore or downplay conflicting information. Beginner investors may fall victim to confirmation bias by selectively seeking out sources or opinions that align with their investment thesis, rather than considering diverse perspectives. This bias can lead to making decisions based on limited information, potentially resulting in poor investment outcomes. It is essential to remain open-minded, gather information from a variety of sources, and critically evaluate all available data. 15. Neglecting to review and adjust investment strategy. A static investment strategy may not be suitable in the ever-evolving market. Beginner investors sometimes neglect to review and adjust their investment strategy as needed. Market conditions, economic factors, and personal financial goals can change over time, necessitating adjustments to the investment approach. Regularly reviewing the portfolio, assessing performance, and making necessary modifications are essential to maintain alignment with one's objectives. Conclusion. While investing in stocks can be a rewarding endeavor, beginners must be aware of the potential mistakes that can hinder their progress. These include chasing high-yield investments, overtrading, ignoring long-term trends, falling for confirmation bias, and neglecting to review and adjust investment strategies. By avoiding these pitfalls and adopting a disciplined, patient, and research-driven approach, beginners can enhance their chances of achieving long-term success in the stock market. As beginner investors venture into the stock market, it is crucial to be mindful of the common mistakes that can hinder their success. These additional mistakes include attempting to time the market, neglecting the power of compounding, and failing to have an exit strategy. By avoiding these pitfalls and adopting a disciplined, research-based, and long-term approach to investing, beginners can increase their chances of achieving their financial goals and building a solid investment portfolio. Entering the world of stock market investing as a beginner can be both exciting and challenging. By being aware of the biggest mistakes made by novice investors, such as a lack of education, over-reliance on tips, insufficient diversification, emotional decision-making, unrealistic expectations, neglecting risk management, and a lack of patience and discipline, beginners can proactively avoid these pitfalls. And there you have it, folks. We've reached the end of our video, and we hope you found it valuable and insightful. Remember, investing in the stock market can be a rewarding journey, but it's essential to steer clear of the biggest mistake that beginner investors often make. By staying informed, managing risks, and exercising patience, you'll be well on your way to building a solid investment portfolio. If you enjoyed this video, don't forget to give it a thumbs up, subscribe to our channel for more investing tips, and hit that notification bell to never miss an update. As always, we appreciate your support and look forward to seeing you in our next video. Happy investing! Thanks for watching.